I do always like to start the show off with a summary of kind of what I saw happen in the stock market this week. And this was a really fantastic week, actually. Going back to, the end of last week, we actually had 7 days in a row where the S&P 500 went up. And that was really exciting, actually, because we had this big downturn that happened in September and October. And in those 7 up days, we managed to get back to an all-time high again on the S&P 500. We closed at that all-time high yesterday and really fantastic. Wiped out all the losses that we'd had in that previous time frame. That sort of I call it a melt up. It was just very powerful. Lots of different participation from different types of stocks, and I think this is really great. So today, it's a little bit down. We'll see what happens. Maybe we won't get to the eighth day, but it's not over yet. So we'll see how that plays out. But I'll talk about some of the catalysts that I saw, and then some of the headwinds that are coming at us here. So the catalysts really were pretty simple. Number one, the decision to negotiate the debt ceiling and come to some kind of resolution to put the debt ceiling out to early December. Market turned around pretty much immediately at that point. So the next thing is really, I think the market is factoring in a lot of the positive information that's coming out around the negotiation on these big bills. We have the infrastructure bill, and we have this Build Back Better plan, both of which, if they got passed, would be stimulative to the market. But more importantly, they would most likely include a debt ceiling increase in those bills. And that would give a huge relief, I think, to the market to have that debt ceiling, pushed out to early December of next year instead of this year. And so I think there's some good news happening there. I think the market's responding positively to that. But the other big catalyst is earnings. So throughout the time frame of the third quarter here, before earnings have been announced, a lot of pessimism. The supply chain is going to bring earnings down with all the issues there. The shortage of labor is going to bring it down. The inflation, well, it didn't, at least in the third quarter so far. For the companies that have reported, they've been very good. It looks like we're on track to maybe have about a 30% increase in earnings on the S&P 500 in the third quarter, which is fantastic. And so those are the pieces that are driving it forward. Looking forward, the things that we want to think about in terms of headwinds are really just two main things. I mean, I talk about a lot of different subjects, but for me, I try to boil things down to the basics and watch how those are working. So number one is the debt ceiling is only pushed off currently to early December. So it's something to watch. It looks like they might push these bills through well before that, but who knows? If they get close to an early December timeframe again, what we did last time was we pulled some of the stock market portions that we have off the table, just because a debt ceiling is a default would be a really big deal. Hopefully we don't have to do that. So we'll see what happens. And the other headwinds has to do with the Federal Reserve, and just, they're going to cut back on purchasing these bonds and potentially start to raise interest rates. As a matter of fact, today the market was up in the morning, and then the Federal Reserve Chairman Powell, made some comments at a conference about cutting back on the bond purchases, and the market came down. So you can see that's an important component of what the market's looking at. But I want to kind of bring something in a little bit more specifically, because I think this is super important. We talk about all these things and all these hurdles these companies have to jump through. We talk about the S&P 500, or at least I do quite often, as this big kind of amorphous blob of companies. But I think it's really important to understand what is in those indexes. And the way the S&P 500 works is what's called a market cap weighted index. So bigger companies have a bigger portion of the price movement of that index. I'm going to read you a list of the top 20 companies on the S&P 500, which makes up 37% of the price movement. So it's a big piece of it, of that S&P 500 index. And I want you to think about these companies and how well they've done in dealing with adversity and different things, and in the past, and how well they might do in the future as far as that goes. So these are by size on this list. So Apple, Microsoft, Amazon, Google, Facebook, Tesla, Nvidia, Berkshire Hathaway, JP Morgan Chase, Johnson & Johnson, United Health, Visa, Home Depot, Bank of America, Pfizer, Walt Disney, MasterCard, Adobe, and Netflix. Think about that list. Those are some unbelievable companies that have done really, really well. And here's my key point. Basically, we have these issues. Think about it. We have this supply chain issues. We have shortage of labor. We have the inflation that's being caused. We have the Federal Reserve that might do some different things. Are these companies going to be able to handle that situation? Yes, would be my answer. They have in the past. And even though we do have these problems, they find ways around them. And the reason that they're so large is because they're some of the best in the world at running their firms. And so there are some potential issues that could happen even to these great companies, a debt ceiling default, or when they raise rates too many times. So, for example, the 2008 downturn, they raised rates 21 times before the markets came down. It came down pretty hard in that environment. And really, again, keep in mind as a real basic concept here that the first increase they're talking about on Fed funds rate is in the end of next year, the first one. So we're a long ways away from having a lot of them. So the basics are there. Hopefully we pass these two bills, increase the debt ceiling so we can get to next December. And then obviously, these companies will be able to deal with these different situations that the Fed is having. Now, I'm not saying that the market won't come down some, and that always happens. I'm just talking about the bigger downturns are a lot less likely in this environment. And the overall upward movement of the market is a lot more likely in this environment when interest rates are this low. So anyway, really good week. Very, very fun to watch, actually. Usually markets come down fast and go up slow. This is coming up really fast. It was really fun to watch that as far as that goes. So look forward to being able to talk to you about what's happening next week.